I'm Brittany Lewis with Forbes Breaking News. Joining me now is Stephen Mathai-Davis, the CEO and founder of Q.ai. Q.ai is a next-gen AI-powered investing app that's backed by Forbes. So Stephen, thank you so much for joining us.
Thanks for having me on this morning, Brittany.
So let's get right to the big market news of the day. So yesterday, stocks wrapped up their worst first half of a year since 1970. So this is coming as the S&P 500 remains in bear market territory, and recession fears are continuing to grow as inflation remains high. So can you break down the current market landscape for us?
Sure, Brittany. So just to start off the year, coming into the end of 2021, we were actually very bearish, and that's when we were advising our customers as well as a lot of our subscribers on newsletters to think about hedging their portfolios and maybe shifting money to less risky assets. After this first half of the year, we're actually more incrementally bullish. It always pays to be contrarian. So I would tell a lot of your listeners that it's time to buy when everyone's afraid and running to the exits. As I would think about going into the second half of 2022, I would encourage people to think more creatively about investing. It's not just about buying the S&P 500. I think it's now time to start thinking about hedging and introducing pair trades. The idea of actually going long something that you're interested in and hedging it by buying an inverse ETF or maybe shorting something similar.
Sure. So kind of going off on what your last point, according to the Conference Board, consumer confidence hit a new 16th month low in June. So consumers are afraid of these looming recession fears. And I know that you said it's time to go contrarian, but based on that sentiment, what investment advice would you give?
Yeah, that's a great idea. So one of the things we've been doing at Q.ai has been telling people to think, not focus too much on the news, but actually try to think logically about how to build your portfolio going forward into what's going to become an increasingly more volatile market. Contrary to what everyone's saying as far as recession fears, we're actually a little bit more bullish because GDP numbers were revised downwards for 1Q. Now remember, GDP is also capturing exports and the impact of investment outside of the U.S. being brought back in. If you look at aggregate demand in the U.S., it was actually positive. That's a positive sign for stocks. Now that's where in some instances, you're hearing economists and the Fed talking about a soft landing. When I talk to our investors, and some of the ideas we've been telling people to think about has been maybe go long large cap stocks and hedge it with a short by being short small cap, right? Because in small cap stocks are going to do fantastic in an environment that's go GDP growth. We're not in that environment. If you're in a slowing growth to a negative growth environment, it's better to be long large cap stocks. And the best way to hedge that risk is to be short small cap. Similarly, we've been telling people, listen, if the U.S. is heading for a recession, guess what? Developed Europe is going to be even worse condition. Makes a whole lot of sense to say, all right, I'm going to hedge that idea. Long, large cap stocks in the U.S., short, mega cap stocks in developed Europe, which you can do with ETFs.
Sure. And would this advice change between a more seasoned investor, maybe Gen X, baby boomer investor, opposed to a newer millennial Gen Z investor?
Yeah, that's a great point. You know, when we think about our investments, because we're really focused on the modern investor, which we're talking about Gen Z and millennial, average age from 22, 23 up to 40. So these ideas are actually built for them. Because contrary to what people think, the average Gen Z millennial investor is primarily invested in stocks and ETFs. And millennial investors today represent $1 trillion of stock market value. That's contrary to what everyone thinks. And they're buying stocks and ETFs. They're not buying mutual funds. And they're buying stocks and ETFs a whole lot more than they're buying crypto.
Okay. And so simply put, what should people be doing to keeping their money growing at the rate of inflation?
Yeah, that's a difficult question, right? And we're getting into financial advice territory. To beat inflation, especially where rates are today, which is still very low on a historical basis, you've got to be in the stock market. And that's where I was talking about the ideas of saying, listen, I'm scared about just being long the stock market. But you can get your head around being saying, I'll be long large cap, short small cap, and I'm going to play that spread. And that spread will outperform inflation, certainly.
Okay, great to know. And so now let's switch gears a little bit to crypto. So Bitcoin and cryptocurrencies had a huge meltdown earlier this year, as we know, dropping to levels that we haven't seen since the market surge in late 2020. So can you discuss the impact that meltdown has had on the current crypto market?
Yeah, I guess to start off, we're really bullish on crypto longer term at Q.ai.
Okay.
And we think it should be a part of anybody's multi-asset portfolio. Now, I've never advocated for being more than 5 to 10%, and that people really should be in stocks and bonds and commodities, and that crypto should be a small allocation there. I think longer term, this is actually quite a good thing. There was a lot of frothiness in the market with a lot of uneconomic perspectives on where crypto was going just tomorrow. Longer term, I think Bitcoin's a great idea. I think part of the issue also in the marketplace is that it's not really productized, crypto.
Sure.
It's really easy to go buy and sell.
Sure.
I'm now speaking just from a financial services perspective. There's no formal financial product. If you wanted to go buy the S&P 500, you're not buying 500 stocks. You're buying a product that's actually managing that. It doesn't exist today in the crypto market. And I think that's going to be the next evolution you see. And that's what's going to introduce more stability. You're not going to have this rampant selling because people are actually going to be investing into portfolio strategies that are allocating funds to crypto.
And who are you seeing invest in crypto the most? Are we seeing Gen Z, Gen X, millennials, or the baby boomer investors?
Well, the market itself is a little nebulous, right? But it's pretty well known that it's primarily Gen Z and then millennial in that order.
Okay, and what advice would you have for people who have invested in crypto and might be feeling a little anxious about this meltdown that happened earlier this year?
Yeah, paraphrasing a really famous saying, this has happened before and will happen again.
Okay.
And I've been involved in crypto since 2009.
Sure.
So I can talk about a lot of the stories that have gone up and down, especially with Bitcoin. Now's the time to begin thinking about maybe putting a little bit more money into it.
Okay, that's good to know. And so now I want to pivot to the energy sector. So it's been a strong 6 months for the energy sector. Energy stocks have outperformed the rest of the market as oil and gas prices remain elevated. But at the end of June, we saw energy prices dip a bit compared to the beginning of the month of June. So experts are saying that these prices have already peaked. Can you give us any insight to this shift?
Yeah, that's a great question. So we were really bullish on getting long energy
Sure.
in late October, and we created an energy kit that was one of our popular limited edition kits. And just this year alone, as we've closed it yesterday, we had a 55% return.
Okay.
And that's just going long the market, going long energy and just actively trading it. Why did we close it? If you look at the forward futures prices for energy, specifically oil, right? It's actually normalizing. Before, the entire market was in contango, which made a lot of sense. Just be long energy. Now, we were actively trading it. You didn't necessarily have to do that. You could have just gone long the market and you could have had a great return. Might not have had the same thing we did. Now, what's happened now, the market itself is beginning to normalize.
Sure.
It doesn't really make sense. You don't really have an edge anymore
Sure.
in terms of being long energy. One of the better trades we like right now is actually being long gasoline.
Okay.
And again, you're playing the seasonal trade in gasoline. Gasoline market futures are actually pricing in higher prices going forward for the next month to 2 months. I would tell our subscribers, but also your viewers, that it would make a whole lot of sense to be long gasoline, and that's where we created this idea of a long gasoline trade where you're short oil and you're playing that spread. Because while oil prices are coming down, anybody who's driving knows this, gas prices aren't dropping as quickly. So you're playing that spread.
So you told our viewers to go long when it comes to gasoline. So what investment advice, other than that, would you have when it comes to the energy sector?
Well, since we're advocating getting out of our energy crunch kit, which was playing the entire supply chain, I think that's probably one of our more exciting ideas today.
Sure.
And this is something I've traded for years, so we're very highly confident in that.
Okay, great. Stephen, thank you so much for joining us today, telling us about the market landscape, and we look forward to having you join us again soon.
Absolutely, and if your viewers would like to learn more about Q.ai and what we're doing, they can check us out at tryq.ai and find out how we're bringing institutional grade investing to the average modern investor today.
Great, thank you.